Lesson number 1. Earn interest with Compound. This is Maya. She is a sophisticated crypto investor with assets on exchanges and in private wallets. However, these assets are effectively idle because she's not earning interest on any of them. Her cash savings account pays interest. Why can't her crypto? This is why Compound was created. With Compound, Maya can earn interest on her crypto assets by supplying them to the protocol. Other users can then borrow her crypto, and then they pay interest on the borrowed assets. All of the suppliers and borrowers who use Compound combine to form a series of blockchain-based interest rate markets. When Maya supplies an asset to Compound, it gets added to a global liquidity pool which other users can borrow from by providing collateral up front. When borrowers in a specific market accrue interest, the Compound protocol automatically distributes it to suppliers like Maya. This idea is already well established in the traditional finance world, where a $5.5 trillion short-term borrowing and lending industry exists in what are called money markets. Compound allows its users to participate in a decentralized money market for crypto assets, where individuals like Maya can supply their assets to Compound and immediately begin earning interest. Compound has no fixed terms, meaning that Maya can supply and borrow when she pleases, whether that's for 30 minutes or 30 years. Once a crypto asset is supplied to Compound, interest is automatically calculated and distributed with each new Ethereum block, every 15 seconds on average. This allows Maya to start earning interest on her idle crypto assets in a trustless economy that doesn't rely on a central authority to manually calculate and distribute her supply interest. But Compound wasn't just built for individuals like Maya. Because Compound is a decentralized protocol running on Ethereum, it works for everyone, anywhere in the world, and can also be integrated with all kinds of financial services and applications. Any application that holds crypto assets can integrate Compound's interest rate markets, unlocking the power of Compound interest to offer brand new features and services. Already, there's a quickly growing ecosystem of apps built on top of Compound that do this. Compound makes this possible by providing the infrastructure for developers to launch future-proof, decentralized financial services and applications that can pass down Compound's benefits to their users, enabling every user to simultaneously begin earning interest. The Compound protocol is a collection of Ethereum smart contracts, meaning it's both decentralized and completely autonomous. It allows Maya, as well as developers using Compound, to stop relying on and paying fees to third parties. That gives it a big advantage over traditional finance. Lesson number 2. Borrowing crypto with Compound. Typically, in order to take out a loan, Maya would have to fill out an application with a centralized financial service provider. It's a long process with a host of requirements and opportunities for bias. To avoid this, Maya could borrow crypto assets directly from Compound instead, using assets she has supplied to the protocol as collateral. In traditional finance, this process of borrowing against supplied assets is called over-collateralized lending. Compound is different from a typical money market, though, because it's decentralized and operates completely autonomously. The only central authority is the code itself. With Compound, Maya, or any financial application or service, can instantly access borrowed crypto assets and then make use of them however they see fit. For example, Maya's goal might be to put an advanced trading strategy into place, like leveraging her borrowed crypto to invest in other assets. To borrow crypto, the first thing Maya does is supply an asset to Compound. Supplied assets immediately start generating interest and can also be used as collateral to borrow any other supported asset of Maya's choice. The more she supplies, the higher her borrowing limit increases. To limit risk across the protocol, Compound gives each asset its own unique collateral factor. This means that each supplied asset will affect the borrowing limit differently. For example, for every $1 of ETH Maya supplies, she can borrow up to 75 cents worth of USD coin. This is because ETH's collateral factor is 75%. Maya earns interest on any assets she supplies, even while they are being used as collateral. This helps to lower the cost of borrowing, as the net cost to borrow can be seen as the borrow rate minus the interest being earned on supplied assets. The interest rate for each Compound market is dynamic and based purely on supply and demand. These rates determine the interest Maya pays for borrowing an asset and are calculated per block, just like when earning interest. This is done to ensure the rates always reflect current market conditions. Over time, markets with fewer suppliers and lots of borrowers will become more expensive to borrow from and more rewarding to supply to, while markets with lots of suppliers and fewer borrowers will become cheaper to borrow from and less rewarding to supply to. In essence, the more an asset is borrowed, the higher the interest rate will rise, and vice versa. With Compound, Maya can save time and borrow crypto instantly, without having to liquidate her other crypto assets, provide her credit score, fill out an application, or wait for an underwriter's decision. Lesson number 3. What is the comp token? Compound's goal is to create a protocol that can run forever and evolve in entirely new ways. In order to achieve this goal, the protocol was decentralized by creating and distributing Compound's native Ethereum token. All changes to Compound originate from comp token holders who can propose and vote on changes to the protocol. Any user or application interacting with Compound can earn comp. The more crypto assets a participant supplies or borrows with Compound, the more comp they will earn in return. Similar to how interest is earned with Compound, comp distribution is calculated dynamically on a per-block basis and distributed to suppliers and borrowers in each market. With the release of comp, every Compound user will earn a say in the future of the Compound protocol without involving the Compound team. This is because simply holding comp tokens will allow users to vote on proposed changes and upgrades, delegate their vote to a trusted person or group to act on their behalf, and submit their own proposals for improvements to the protocol. Each proposal is executable code, meaning that there is no space for different interpretations and doesn't require a centralized team to implement. What's seen within a proposal is exactly what will get deployed if it's voted in by the community. When a proposal succeeds, it directly upgrades the protocol, allowing for new assets, revised interest rate models, and new functionality to be added over time. This puts the power of governance into the community's hands. It creates a global protocol that is upgradable and can grow alongside the ever-changing needs of its users in new and unique ways. When this video was created, about 2,880 comp was being distributed per day across all eligible markets. As market conditions evolve, so too will the allocation of distributed comp between users. The amount of interest paid by borrowers in each market affects how much comp is awarded to participants of that market. The more interest paid, the more comp is earned. While some markets will earn more comp than others, suppliers and borrowers of any specific market will always earn an equal share. 100 years from now, Compound hopes for the protocol and its interest rates to be integrated into many applications around the globe, enabling entirely new products to come to life across a wide range of industries and use cases. This will allow financial applications and end users to make use of idle crypto assets and gain instant access to borrowed funds, all while supporting the ongoing development of unique financial applications and services worldwide. Collectively, it is up to comp holders like Maya to decide the future of the protocol. With Maya's help, and with the support of Compound's community of developers and users, Compound hopes to continue to evolve over time, adding new integrations and supported assets to grow the reach and capabilities of the protocol for many years to come. Lesson number 1. What is Kyber? This is Hannah. Hannah wants to buy a new outfit for her avatar in her favorite online game. She's got some ETH in her crypto wallet. Unfortunately, the game's online store only accepts one particular token, DAI. Hannah has ETH, but she needs DAI. What can she do? She could use a cryptocurrency exchange to exchange her tokens, but that's pretty time-consuming. She'd have to sign up for an account, send her ETH to the exchange, place a trade, or 2 trades if there's no direct Ethereum to DAI market, and then send her DAI back to her wallet. That's a lot of time and effort, and it's difficult for Hannah to know if she's getting a good exchange rate or paying reasonable fees. Plus, not all exchanges support every token, so Hannah might need to have more than one exchange account to move between different tokens. This is why Kyber was created. Kyber is a decentralized protocol that aims to make exchanging Ethereum tokens easy and frictionless. It acts like a universal money changer for many different Ethereum tokens. To do this, Kyber connects over 40 decentralized markets together and seeks to find the best exchange rate on the user's behalf. This means that Hannah can use any decentralized application that is powered by Kyber to conveniently swap her tokens. For example, Hannah can convert her tokens using an Ethereum wallet that has Kyber built into it. Or she could use Kyber Swap to swap tokens. Kyber Swap is a non-custodial interface for Kyber. No sign-up is required. Finally, Hannah's favorite online game could integrate Kyber directly. Instead of limiting themselves to DAI for in-game purchases, the game's developers could use Kyber to accept any Ethereum token. After receiving a payment, Kyber will automatically swap the customer's payment for DAI. This lets customers like Hannah spend the token they have, while developers collect payment in the token they prefer. Today, Kyber is one of the most widely used decentralized finance protocols on the Ethereum blockchain. It can make exchanging tokens fast and simple, and that makes crypto a lot easier to use. Lesson number 2. What is KNC? KNC, or Kyber Network Crystal, is the Ethereum token that's used to govern the Kyber protocol. Every KNC holder has the right to vote on proposals to improve the protocol. Voting with KNC is simple and rewards everyone who participates. Let's take a look at how voting works. Hannah has some KNC tokens in her crypto wallet. To vote, she visits kyber.org. Next, she follows the instructions on kyber.org to stake her KNC. Staking is the process of locking up funds to participate in the protocol's governance. Staking is required if she wants to vote, but she can stake and unstake her KNC whenever she likes. After Hannah stakes her KNC, she becomes a member of the Kyber Decentralized Autonomous Organization, or Kyber DAO. As a member of the Kyber DAO, she can vote on a wide variety of topics, including proposals to improve the protocol, changes to Kyber's transaction fee, and changes to how the fees are distributed. Transaction fees are collected whenever someone uses Kyber to exchange one token for another. These fees are collected in ETH, the native token of Ethereum, and distributed to stakeholders as rewards. As an example, the Kyber DAO might vote to use some of the fees to purchase KNC and burn it, or remove it from circulation, some of the fees to reward the reserves that provide liquidity for trades on Kyber, and some of the fees to reward members of the Kyber DAO, like Hannah. The fees are distributed roughly every 2 weeks. The more KNC Hannah has staked and the more active she is in voting, the more rewards she'll receive. In addition, the more Kyber grows, the more rewards there will be for distribution. If Hannah doesn't want to vote but still wants to receive rewards, she can also delegate her voting rights to a third party who can vote on her behalf. The KNC token is a critical part of the Kyber ecosystem. It gives every holder a way to be part of the development of the Kyber protocol. By distributing rewards, it also incentivizes each token holder to actively participate in improving the protocol. Lesson number 3. How does Kyber power DeFi? Today, the world of traditional finance is highly centralized, dominated by big banks, insurance firms, and corporations. In the world of crypto, however, a different approach is gaining popularity. It's called decentralized finance, or DeFi. DeFi is a new financial system built on public blockchains like Ethereum. It allows regular people to access a wide variety of financial products and perform standard transactions, such as borrowing, lending, and trading, without the need for slow, expensive intermediaries. It's also inherently global. Unlike traditional financial apps, DeFi applications have no geographic or income restrictions. All you need is the internet. DeFi apps are made for regular people, like Hannah, too. With DeFi, Hannah can exchange assets, lend assets to earn interest, take out loans, purchase insurance, or automate her investment strategies right from her laptop, phone, or tablet. As a result, it's thriving. Thanks in part to hundreds of blockchain developers, DeFi apps on Ethereum grew over 700% in 2019. Many of these apps are using Kyber as well because Kyber plays a helpful role in DeFi by enabling liquidity. Liquidity is the ability to convert one asset to another quickly and efficiently. Every participant on Ethereum, apps, wallets, exchanges, and users can use Kyber for liquidity. This is possible because of Kyber's open source protocol and smart contracts. Smart contracts are permissionless pieces of code that are available for anyone to use. Developers can use Kyber's smart contracts to convert one asset to another. For example, when Kyber is integrated into a shopping app, Hannah can pay for a product using token A, while the merchant receives payment in their preferred token B. Or with a Kyber integrated asset management app, Hannah can automatically rebalance her token portfolio to her desired allocation. Because these Kyber transactions take place entirely on the blockchain, they are 100% verifiable and can't be altered. Today, Kyber is a popular and widely used DeFi tool. It gathers liquidity from over 40 sources, helping ensure a competitive rate when exchanging tokens. If users like Hannah hold KNC, they'll get the opportunity to play a role in Kyber's governance and the future of decentralized finance as well. To learn more about how Kyber powers decentralized finance, visit kyber.network. Today's global financial infrastructure has a big communication problem. There are a lot of different currencies and a lot of different payment systems. Each one speaks a different language, so they have a hard time understanding each other, which makes moving money slow and expensive, and a lot gets lost in translation. Stellar's vision is to unite the world's financial infrastructure so money can flow quickly and cheaply between banks, businesses, and people. The internet connected the world's computers so information could be shared globally. Stellar is doing the same for money. To accomplish this vision and ensure integrity and neutrality, Stellar is not a bank or a business. Instead, it's a decentralized open network, supported by a nonprofit foundation that handles every currency and speaks to every payment system in its native language. That means businesses can move money globally in seconds, no matter what bank they use back home. And people all over the world can use Stellar to send money to family overseas, to convert one currency to another, or to make payments that are too small to cover fees traditionally charged by today's institutions. In the future, Stellar hopes that you won't have to use traditional infrastructure to get your money where you want it to go. Instead, you'll just use Stellar. Stellar is a platform that connects banks, payment systems, and people so they can easily move money anywhere in the world. To help make this possible, Stellar has created a cryptocurrency, the Lumen. The Lumen is the native asset of the Stellar network. It serves as a kind of universal translator between each currency. Here's how. Imagine a business in the United States needs to pay a supplier in China. They've got US dollars in their bank account in Kansas City, but they need the payment to show up as Chinese yuan in the supplier's account in Guangzhou. What can they do? They could send money the traditional way via international wire transfer. But that's slow. International wires take several days to clear. Complicated. In many cases, funds move through multiple intermediary banks before reaching their destination. And expensive. Each intermediary takes a percentage of the transaction in fees. As money moves around the world, the fees pile up, and the business in Kansas City loses more and more of its hard-earned cash to unnecessary middlemen, as does the supplier in China. By comparison, what if the business used Stellar? Stellar has a decentralized exchange built right into the protocol. It can route a payment in US dollars through its order books, so it comes out on the other end as Chinese yuan automatically. If there's no good offer to exchange dollars for yuan, lumens act as an intermediary. Stellar simply converts dollars into lumens, and then converts lumens into yuan, all in under 5 seconds, and for a fee of 1/10,000th of a cent. In addition to serving as a universal currency translator, lumens also protect the integrity of the network by preventing spam. Transaction fees are paid in lumens, And every Stellar account has a minimum balance, too. The transaction fees and minimum balance are low enough that legitimate users don't really notice them, but high enough to disincentivize spammers. Lumens are a critical component of the Stellar protocol. They allow it to be efficient, scalable, and they serve as a universal translator for assets. So you can move funds cheaply, but not too cheaply, with the transparency and security only a decentralized blockchain can provide. That's a big step forward for financial infrastructure, all thanks to Stellar. This is Maria. She lives in the United States. And this is Maria's mom, Paulina. She lives in the Philippines. Today, Maria wants to send her mom $20. This is called a remittance. Remittances are money sent to support a family member in another country. And they're a very big deal. The World Bank estimates that global remittances are over $600 billion every year. Unfortunately for Maria, sending a remittance is pretty expensive. Her bank in the U.S. has no connection to her mom's bank in the Philippines, so she has to use a money transfer service, which means paying a lot of fees. One popular American service charges a 3% conversion fee, and the transfer takes 3 to 4 days. The same service also offers to do the transfer faster, but for an additional fee of $9.99. If Maria used this service to send $20, it would mean half the amount would be spent on fees. That's a huge percentage. And Maria and Paulina are not alone. The average fee globally for remittances is 7.1% of the transaction. And there are millions of people who pay these fees every day. But what if Maria used Stellar? Stellar is a decentralized platform that unites banks, payment systems, and people so they can easily move money anywhere in the world. If Maria used Stellar to send her $20 to Paulina, the Stellar network would convert her US dollars to Philippine pesos in less than 5 seconds. So Paulina would receive $20 worth of her local currency, not $20 minus fees. Stellar makes this possible by connecting financial institutions to the Stellar network, which has a built-in order book that exchanges assets. So Maria could send US dollars or any other currency to her mom, and it's converted automatically to Philippine pesos. That's the vision of Stellar. Stellar is a platform that aims to connect banks, businesses, and people far more efficiently than today's financial infrastructure. Let's take a bank, a business, and a person and show you how this works. First up, the bank. This is Main Street Bank. To use the Stellar network, Main Street Bank sets up a Stellar account. Then, using Stellar's built-in tools, the bank hooks its existing infrastructure into the Stellar network. Now the bank can take its real-world assets, like dollars, euros, or pounds, and turn them into Stellar tokens. And their customers can deposit a US dollar in Main Street Bank and get a US dollar token on Stellar in return. All Stellar tokens are exchangeable. And since exchanges happen on the Stellar network, they only take a few seconds and cost a fraction of a penny. Anyone can transfer, store, and trade Stellar tokens, just like Lumens, anywhere on the Stellar network. So now the bank can take a dollar, turn it into a token, transfer it around the world in 2 to 5 seconds, and convert it back to a dollar again. For banks, Stellar makes money transfers fast, simple, and inexpensive. Next up, the business. Let's call it ABC Technologies. ABC makes an app. They want to make it possible for the app's users to buy and sell in-game items with each other using a single currency. To do that, they use Stellar to create a new token called the ABC token. The ABC token is, in effect, a new cryptocurrency running on Stellar. It isn't backed by a real-world dollar like Main Street Banks, but other than that, it acts entirely the same. With Stellar, any business can create new tokens to reward customers and create new economies and markets related to their brands. Finally, we have people. This is Lee. She's a big fan of ABC's app, and she wants to buy a new avatar. Unfortunately, she doesn't have any ABC tokens left. So what does she do? She uses Stellar's built-in marketplace to buy some. Lee has US dollar tokens that she previously bought from Main Street Bank. She transfers those into the ABC app and instantly converts them into ABC tokens to buy her favorite avatar. And if she has some US dollar tokens left over, she can return them to Main Street Bank and get her dollars back right in her bank account. Or she can hang on to them or trade them for another token. Any asset can be turned into a token on Stellar. Traditional currencies, cryptocurrencies, real estate investments. So whether you're a bank, a business, or a person, Stellar makes it possible to quickly and efficiently issue, exchange, and transfer tokens in an entirely new way. Stellar is a platform that connects payment systems and people. It's a decentralized network, meaning no single company has the power to turn it off. Stellar's decentralized network is made up of all the independent computers that run Stellar's software. Anyone can join. Stellar's network is different from Bitcoin's in a few key ways. Computers on Bitcoin's network compete with each other to validate transactions through a process called mining. This requires expensive hardware and lots of electricity. Stellar doesn't rely on mining because when a network's miners disagree, the network can split in two. This has happened in the past with both Bitcoin and Ethereum. But because Stellar allows digital versions of real-world assets like digital yuan or digital bonds, Stellar had to devise a way to prevent the creation of duplicate versions of those assets. For example, if a dollar on Stellar were duplicated, its backing bank would suddenly owe two real-world dollars, one for each copy of the network. This would obviously be a problem. So Stellar uses a unique way to settle transactions developed by researchers at Stanford University. Here's how it works. Stellar relies on cooperation within the network rather than competition. Each company doing business on Stellar connects a computer to the Stellar network. It picks a few other computers it always wants to agree with, it processes the transactions they process, and keeps its list of transactions aligned with theirs. The computers the company depends on, in turn, have chosen to agree with others, and those ones agree with still other computers, and eventually the whole network is covered in an interlocking web of agreement. It's actually very similar to how the Internet's web servers work. Stellar uses this pattern to guarantee the network's safety. Every 5 seconds, the connected computers negotiate with each other according to very specific rules to finalize their agreement. They cross-check each other across the whole network, all at once. The rules of the system have been designed so that even if bad computers participate, accuracy and stability are maintained. This agreement system is called the Stellar Consensus Protocol. It allows computers running Stellar to process transactions in under 5 seconds without using a significant amount of electricity and for a very, very small transaction fee. So who runs Stellar nodes today? Global banks, developers, businesses, anyone who wants to transfer money via the Stellar network. Stellar is simple to set up, free to use, and above all, it's open to everyone. And that's a big improvement over today's international financial infrastructure. What is MakerDAO? MakerDAO is a decentralized organization whose core mission is to enable greater financial freedom and to level the economic playing field for everyone, including those looking for more control over their assets or those living in economies suffering from hyperinflation. It does this via the Maker Protocol and its two native tokens, DAI and MKR. The Maker Protocol is a decentralized finance or DeFi application that allows its users to borrow funds by supplying collateral. It's currently one of the largest applications on the Ethereum blockchain and was one of the first to obtain significant user adoption. Maker's operations are completely decentralized, removing single points of failure, preventing interference from centralized parties, and making upgrades transparent and rule-based. DAI is a stablecoin that aims to always be worth $1. It mitigates volatility through an autonomous system of smart contracts, as well as through decentralized community governance. Many stablecoins today are fiat-backed. The issuers take real US dollars, put them in a bank account, and then issue tokens that represent those dollars. But DAI is different. It doesn't rely on dollars in a bank account. Instead, DAI is generated when users deposit supported crypto assets as collateral. All DAI within the Maker ecosystem is backed by a surplus of collateral that has been individually locked into audited and publicly viewable Ethereum smart contracts. MKR is a governance token that works to help keep the value of DAI as close to $1 as possible. MKR also powers Maker's decentralized, community-driven governance. Anyone can purchase MKR and join the global community of MKR token holders, helping to govern the Maker protocol and maintain DAI's stability by voting on proposed changes and upgrades. Token holders like Margaret can view the current list of proposals being debated and voted on by visiting the MakerDAO forums. She can also check the history of all previous proposals and outcomes on the Maker governance dashboard. When she has completed her research and has decided what she thinks is the best decision for the overall stability and health of MakerDAO, this is where she can submit her vote, too. Maker governance. In the Maker protocol, all decisions and upgrades are managed by the community of MKR token holders who take on the responsibility of governing the platform to ensure it operates effectively and continues to thrive. Each MKR token gives its owner one vote per proposal. Proposals might include changes to the cryptocurrencies the protocol accepts as collateral, or an adjustment to the operational model or stability fee. The stability fee is a variable rate that reflects the cost paid by borrowers who deposit collateral in order to generate DAI. Because DAI is not mined and minted only when collateral is deposited by borrowers, the cost to borrow directly affects the amount of DAI in circulation and, in turn, its market value. By voting to change the stability fee, Margaret and the global community of MKR token holders can change the incentives that impact the supply of DAI in order to keep its price as close to $1 as possible. For example, if DAI's market price falls below $1, the community could pass a proposal to increase the stability fee. This would help to decrease the amount of DAI in circulation, potentially raising its price. The system is structured to reward prudent management by MKR holders. If MKR holders make good decisions and the system performs well, stability fees paid by users will accumulate as surplus. If that surplus goes beyond a certain threshold, as decided by the community, the excess DAI is auctioned in return for MKR, which is then burned or permanently removed from circulation. If MakerDAO becomes under-collateralized, meaning there is more DAI on the market than collateral locked in the system will initiate an auction where MKR is minted and sold for DAI, which is then burned. This sale aims to bring the system back into balance by ensuring that any outstanding DAI is backed by an excess of collateral. These auctions incentivize MKR token holders like Margaret to govern the system well, as they may benefit from a decrease in MKR supply or may be negatively affected if bad governance decisions lead to new MKR being issued. What is the vision for MakerDAO? The Maker protocol was created to help people around the world unlock access to the global financial marketplace. Maker provides financial tools and resources for users like Margaret that are secure, stable, and transparent. Users only need a crypto wallet and some crypto. With just these two things, anyone can securely generate DAI by opening a Maker vault. There's no involvement from a bank or set repayment terms. Maker users pay DAI back to their vaults whenever they like, or not at all if they don't want to. Margaret has a friend named Pablo who lives in a country with hyperinflation. His local currency is constantly declining in value. He also doesn't have access to a US dollar bank account. To help protect his savings, earnings, or portfolio, Pablo could purchase DAI from a cryptocurrency exchange. Holding DAI offers a low barrier to entry solution for storing value without having to worry about inflation and price volatility. Pablo could also put his DAI in a DAI savings rate contract, helping to secure DAI's value and earning more DAI in the process. Today, Maker vaults accept a variety of cryptocurrencies as collateral for generating DAI. Each cryptocurrency is voted on by MKR holders. In the future, MakerDAO hopes to take a major step forward in improving blockchain scale and growth by adding support for real-world collateral assets like gold, tokenized real estate, and blockchain-based bonds. Maker also envisions a world with greater financial transparency. Because DAI is collateralized by crypto on public blockchains, rather than dollars in private bank accounts, the value of individual vaults can be confirmed by anyone, not just by select employees of a single bank. Anyone with an internet connection can monitor the health of the system, token supply, collateral amounts, current fees, and more by visiting DAIstats.com. This site hosts important stats about Maker that are free to access and verifiable via the blockchain. As DeFi becomes more popular, MakerDAO hopes that this level of transparency, coupled with decentralized governance, will increase economic empowerment for users across the world. Lesson number 1. What is the Celo platform? Meet Zoe. She's tech-savvy, always connected, and gets everything done on her mobile phone, like shopping for groceries, hailing a ride, or catching up with friends. If money could be this convenient, accessible, and borderless, what could it do for Zoe, her community, and the world? This is Celo's mission, to empower Zoe and the 6 billion smartphone users worldwide with accessible financial tools that allow them to unlock the benefits of blockchain technology and stablecoins right from their mobile devices. No bank account or additional hardware required. Using the Celo platform and the first stablecoin supported on the platform, Celo dollars, Zoe can send funds to a friend or family member globally as easily as sending a text message. She can also contribute to causes she cares about, or even provide a microloan to her favorite small business to support them. Since Celo is mobile-friendly, Zoe can send funds straight to a mobile number, even if the recipient doesn't have a crypto wallet yet. Celo makes this possible through a number of technical innovations. First, an on-chain public key infrastructure links phone numbers to public keys, so there are no long, complicated crypto wallet addresses to manage. All Zoe needs is her phone number. Second, the Celo platform is fast. Blockchains are known for slow speeds, requiring nodes to download gigabytes of transaction history data before exchanging funds. Celo eliminates the need to verify all previous transactions and allows instantaneous verification of the blockchain using advanced ZK-SNARK cryptography. This gives the Celo platform a 17,000x reduction in the amount of data needed to sync with the network, allowing Zoe to easily make a payment or send funds within seconds. Third, Celo dollars, the first stablecoin that can be sent directly using just a mobile phone number, allows Zoe to make fast, low-cost transactions on the go. They can even be used to pay for transaction fees, unlike on other platforms. Finally, Celo also works across different carriers and countries, enabling access to financial services from almost any mobile phone in the world. And since Celo is an open platform, any organization can use, contribute to, and build on top of the technology to create mobile-first financial solutions that can be accessed by any mobile phone user like Zoe. By making cryptocurrencies easy to use, Celo aims to support greater access to financial tools and services, helping to create new opportunities for individuals and communities worldwide. Lesson number 2. What is Celo? This is Celo, Celo's native asset. It's the core utility, reserve, staking, and governance asset for the Celo community. Everyone who owns Celo gets a say in how the platform evolves and grows over time. And this is the Celo dollar, the first stablecoin on the Celo platform. Its value tracks the US dollar and is built for accessibility and ease of use. Celo, alongside other crypto assets like BTC and ETH, serves as a reserve asset for stablecoins, like the Celo dollar, that run on the Celo platform. Celo has a fixed supply and a variable value related to the total value of stablecoins in circulation in the Celo ecosystem. It also plays an important role in the platform's stability mechanism, which adjusts its supply of stablecoins dynamically in order to keep their price as close to the target value as possible. This is done automatically and is publicly verifiable, eliminating the need for a central authority to make estimates on how the supply should be expanded or contracted. As demand and usage of Celo dollars grow, Celo's value may rise as the protocol buys Celo to place into the reserve. The protocol can then use this Celo to buy back Celo dollars during a contraction. In a nutshell, Celo's value depends in large part on the ongoing usage of the platform and the stablecoins over time. Additionally, Celo functions as a staking asset for Celo's proof-of-stake protocol. This means that Celo holders like Zoe can support the security and growth of the platform by staking Celo to elect validators. By voting for trustworthy and secure validators, Zoe helps to ensure transactions can run smoothly and securely on the Celo network. Zoe can also use her Celo to help shape the future of the platform by voting for new features and new stable assets, or proposing her own changes to the platform's operational or economic models. One of the first proposals voted into effect on the Celo platform helped to enable carbon offsetting, making the Celo blockchain one of the first carbon-neutral platforms. This is just one example of how a mission-aligned community like Celo can make an impact, building on the core principle of making the world a better place through innovative financial tools and technologies. Lesson number 3. What can Celo dollars do? Price volatility can be one of the main obstacles for people like Zoe who are thinking about adopting cryptocurrencies. For cryptocurrencies to be practical for day-to-day use, users need to know that the value of the crypto they sent is exactly what will be received. Existing stablecoins aim to solve these problems, but some can have slow networks, usability issues, and high barriers to entry for the average user. This is where the Celo platform is different. Built specifically with ease of use and accessibility in mind, Celo dollars allow Zoe to make use of a stablecoin that is practical and cost-efficient for many day-to-day use cases, and can be accessed from the convenience of her mobile phone. Like other stablecoins, Celo dollars reduce volatility risk for everyday people like Zoe by following the price of the US dollar. But since the Celo platform is built to be mobile first, Zoe can transact with Celo dollars on any mobile phone using an application that is compatible with Celo. One example is Valora, a global payments app that allows Zoe to easily pay, send, and store Celo dollars on her mobile phone. Valora makes use of the full functionality of Celo dollars in the Celo platform. allowing Zoe to send or receive funds from anywhere in the world within seconds, securely, and with very low fees. With traditional international payments, Zoe might have to wait hours or even days as intermediaries process the transfer, incurring many fees along the way. As Celo is digital and doesn't rely on payments being manually processed, transferring funds essentially becomes borderless and instant. Zoe can send funds directly to anyone, anywhere within seconds, just by using their phone number. This works even if the recipient doesn't have a crypto wallet. This is great for Zoe, since she needs to send funds to her mom in Mexico right away. Since Valora is a mobile app, all Zoe needs to do is download and set it up, top up her balance with the required value, and enter her mom's mobile number to be able to send the payment. Once Zoe sends the funds, her mom will get a text message letting her know that she's received a payment. Zoe's mom, who is new to using cryptocurrencies, can use the provided link to download the Valora app and claim the 100 Celo dollars that Zoe sent. Amazingly, all of this happens in a decentralized way, using smart contracts that live on the Celo platform. Celo dollars were designed to help unlock the benefits of stablecoins and cryptocurrencies, and sending money across borders is just one of the uses that Celo dollars can fulfill for Zoe and her mom quickly and directly. Alongside the Celo native asset and the family of applications built on top of the platform, Celo's ultimate goal is to innovate around the way we use money, making it borderless, easy to use, and accessible for all. Lesson number 1. What is Algorand? Algorand is a blockchain platform that aims to be scalable, secure, and decentralized, all at the same time. It was created by a team led by Silvio Macaulay, a Turing Award-winning cryptographer who helped invent one of the most important concepts in cryptography, the zero-knowledge proof. Silvio saw the tremendous potential of blockchains and cryptography to provide fast, irreversible transactions. However, he realized that many early blockchain platforms faced fundamental challenges with the way they were constructed. They suffered from what is known as the blockchain trilemma. Cryptocurrencies built on the blockchain are designed to be more secure, scalable, and decentralized than traditional money. But the blockchain trilemma suggests that you can't have all three of these features at the same time. In other words, you can have secure transactions, but because security takes a long time to verify, you can't do many transactions at once. Or you can have faster transactions and more of them, but they won't be as secure. Or you can have fast and secure transactions, but only if the network is controlled by a small number of participants. Algorand aims to solve the blockchain trilemma by being fast, secure, and decentralized. It accomplishes this in part through a new consensus protocol called pure proof of stake. When a cryptocurrency is transferred, say from an exchange to a wallet, that transaction is added to the most recent block on the blockchain. The consensus protocol is how all the nodes on the network reach agreement about what's in each block. Older blockchains use a consensus protocol called proof of work. If you look at proof of work through the lens of the blockchain trilemma, however, you'll find that while it's secure and decentralized, it's not extremely scalable. This is because validating a block can take a long time, and blocks can only hold a limited number of transactions. Different blocks can also end up being validated within a few seconds of each other, causing the blockchain to temporarily fork for a block or two before returning to consensus. For this reason, many crypto exchanges require several confirmations, which can take up to an hour, before a transaction is considered final. Algorand's consensus protocol, pure proof of stake, is designed to fix this by having scale built in, avoiding forks, and providing instant confirmations. We'll take a closer look at how this works in the next lesson. Lesson number 2. What is pure proof of stake? Today, anyone in the world can send and receive Algo, the native token of the Algorand blockchain, in a matter of seconds with nothing more than an internet connection and a compatible crypto wallet. This is because of Algorand's unique consensus protocol, pure proof of stake. Let's look at how pure proof of stake works. Like all blockchains, transactions on Algorand are grouped into blocks. However, instead of miners with lots of computing power competing to propose new blocks, which is the case for Bitcoin and others, Algorand nodes are selected randomly using a verifiable random function, an open-source cryptographic technique that was co-created by Silvio Macaulay. The selection process works a bit like a lottery. The odds of being selected to propose a block on Algorand are dependent on how many Algo tokens a node is holding. Holding tokens for this purpose is called staking. When you stake Algo tokens, you give them a chance to be selected. The more you stake, the better your chances become. In pure proof of stake, a single algo token is randomly selected every few seconds. If that token is being staked, then the owner of that token gets to propose the next block. If it's not being staked, the protocol randomly selects a different token. In the second phase, approximately 1,000 tokens are randomly selected. The owners of these tokens then become a committee that verifies the block. This process repeats continuously, on average every 4.5 seconds, with new algo stakeholders randomly selected each time. Owners of tokens selected in this process receive algo as a staking reward. So, how does pure proof of stake help solve the blockchain trilemma? First, it's scalable. Because verifying blocks requires minimal computing power, thousands of transactions can occur every second. Second, it's secure. When a stakeholder is selected to propose a block, only they know they've been selected. This prevents anyone from being targeted by attackers. Finally, it's decentralized. The pool of participants changes randomly every few seconds, preventing a handful of algo stakeholders from controlling the network. What about forks? Algorand is designed to never fork and has been formally verified that it will never do so, so transactions are never reversed. This is because only one block can be confirmed at a time. When it's confirmed, the transactions in the block are instantly final. Lesson number 3, the future of Algorand. The world has a significant problem today with financial inequality. There are more than 2.2 billion financially underserved adults in Africa, Asia, Latin America, and the Middle East. Financial opportunity for many people is inhibited by a lack of transparency, accountability, and access, with financial intermediaries driving up transaction costs and delays. The Algorand team is committed to breaking down these barriers, giving everyone an opportunity to participate in a borderless economy. Today, the Algorand team consists of internationally recognized researchers, mathematicians, cryptographers, economists, and business leaders from global technology companies, all working to ensure that the platform remains inclusive and sustainable in the future. This helps fuel Algorand's continuous innovation, and the protocol has already had 4 significant upgrades since the mainnet launch in 2019. These upgrades are support for fast, low-cost smart contracts, a Layer 2 solution for cross-chain interoperability within smart contracts, support for atomic swaps, enabling simultaneous, trustless multi-party transactions, and the ability for users to create their own fungible and non-fungible tokens via the Algorand Standard Asset, or ASA. ASAs can be issued by developers and organizations for many different purposes, including reward tokens, digital proofs of ownership, and stablecoins. In 2020, 2 of the world's most popular stablecoins, USD Coin and Tether, were issued on the Algorand blockchains as ASAs, providing instant transaction confirmations, lower transaction fees, and increased liquidity for tokens issued on Algorand. The Algorand team hopes that developers and organizations will use the protocol to create truly transformative financial applications for financially underserved people around the world. To further help fuel adoption and innovation, Algorand is establishing grants for developers, researchers, educators, and community ambassadors that wish to help support the protocol by contributing to the ecosystem.